Good morning, everyone. It is my pleasure this morning to be joined by Mark Eibel, the Director of Client Investment Strategies, joining us from Russell Investments, one of our key investment partners. Welcome, Mark, and welcome to Calgary. Mark is joining us from Seattle on a bit of a cold, wintry morning.
It's great to be here. Thank you very much for the opportunity.
So, one of the things, Mark, that we were hoping to do is you sit in a very unique position with some excellent perspective on economic developments right now and how that may be impacting investment markets. What we were hoping to do this morning is just share your perspective on some of the big questions that end investors may have right now. So let's just start with one of the main ones, which may be what have you seen as the main factors driving market performance so far in 2025? And what are your expectations, Mark, in terms of how this continues?
Yeah, for 2025, and most of my perspective is going to come from a U.S. perspective, obviously being based in the U.S. But there's so many similarities between what drives our market, I think, and what drives your market. I think this year, number one, it's been phenomenal, right? I mean, markets all around the globe have it's been a remarkable year, and I think the commonalities between the U.S. and Canada, still a strong consumer, which flows through to earnings. Earnings have been very good in both locations, and interest rates have
Right.
been dropping. And really, I mean, Canada has led the charge in dropping interest rates, really kind of around the globe. Those have all been the main drivers. Now, the U.S. has an additional driver, which is, I'm sure, a driver here, but just not as to the same degree. It's just the tremendous spend on AI. And we could do an entire talk on
Right.
how do you recoup all this money and how do you make it all back. But if we go back to the late 90s and go forward 25 years, I don't think any of us would have dreamed technology being so in so many different areas of our life in ways we didn't imagine. So we'll have to see how that story unfolds. But when you add that all up, it's been a pretty good backdrop. Inflation's been dropping everywhere, including the U.S. as well as in Canada as well. So the backdrop, despite the fact that valuation levels are pretty high, not as much in Canada, but in the U.S.,
Right.
you need an event almost to say, well, what can change course of this in 2026? Valuations themselves can continue to go higher. You need something to happen, and right now it's difficult to see what that event might be. Central banks are lowering rates, inflation is dropping, earnings still look good. This consumer, at least the wealthy consumer, seems to be spending everywhere in the world. And again, then you get the AI effect in there as well. So I think the outlook is still looks okay for next year, but this year was just beyond expectations, I think, in both U.S. as well as around the globe.
Okay. And you touched on earnings, and I think that's been one of the things that we've continued to see really strong earnings out of the US, also in Canada, despite maybe what some of the headlines, right, might be leading us towards. So, can you share, Mark, your perspective on just, especially early in the year, I think in 2025, there was a lot of conversation about recession risk.
Right.
Here we are, late in the year. Just what are your thoughts? Do you still see that recession risk looming from where you sit right now?
In the US, not as much. And again, I think a lot of it is simply the tremendous spend in AI and the wealthy consumer. And it really comes down to your belief on those two. If you believe the wealthy consumer will continue to spend and that the AI spend will continue, I think the recession risk is lower even in 2026. Now, I think as we look at it in Canada, Canada has a higher unemployment rate.
Right.
The recession risk is higher. Your economic growth, I mean, you're bouncing around 1% plus or minus. And quite frankly, once you get into these ranges, whether you're technically in a recession or not, doesn't really matter other than the term. And I know people kind of freak out when they hear the term recession. But I mean, as you've seen, your central bank is already lowering interest rates. It's very typical to kind of get ahead of it. So I think the recession risk in Canada is higher, maybe more of a 50-50 than in the States, where I'd say it's probably lower, maybe a 25% probability for recession.
Mm-hmm.
But uh, again, I think people read too much into that term recession. You're growing right now, so we'll have to see where it goes there. But yeah, I think the risk is a little bit higher in Canada than the U.S.
Okay. And that's helpful just to give that perspective. Now, based on that, and maybe thinking a little bit outside of even North America, are there any specific sectors or regions, that the team at Russell Investments may be looking at right now as particularly attractive?
Yeah, and obviously, it probably goes without saying, but I'll say it anyways. I mean, we're very diversified. We're always invested in all these parts of the market. But I think if you're looking for opportunities, almost anything other than large cap growth in the United States. Now, do I think they can continue to do well? Yes, tremendous companies. We're going to get Nvidia earnings today. That'll be a tell on market direction with such lofty expectations where we go from here. But everywhere else in the world is just cheaper. And I think you saw that this year, right? You get cheaper stocks. You tend to get bigger dividends once you leave the United States. And from at least from a U.S. investor perspective, we've had a weaker dollar this year, which we haven't been able to say in nearly 20 years. And there's always pros and cons on if you want your currency weak or strong or not. But
Right.
if you're making money outside of your country and you translate it back into your own currency, it's a headwind if the currency's strong. It's a tailwind if the currency's weaker. I mean, emerging markets are up nearly 30% this year or over 30%. And a lot of that is simply from a weak dollar effect. So I think this market this year, the return pattern this year, with everybody in the world participating, the rest of the world's markets outperforming the US markets, it's just a healthier, diversified portfolio than how it's felt over many years, which is the world almost relying on 7 technology companies in one country, the US kind of driving all of the returns. This is a much healthier market. And again, there's an offset. There's a lot of growth, obviously, in the US, but the cyclicality and all the other sectors, financials, you can just get high quality companies that are cheaper with bigger dividends, and I get a currency hedge from a U.S. investor's perspective along the way. So I do think there's opportunities in markets, and moving forward, I think a 60-40, getting it from different return sources is a much healthier place for the average investor to be in than just relying on one part of the world in order to deliver those results.
Right. And I want to just go back, one of the things that you talked about and maybe just leads into a next question, just on risk. You talked about the leadership over the last several years has really come from that high growth technology sector in the US. Looking forward now, from a risk perspective, are we actually now hopefully moving into an era of less risk because we're seeing more opportunities or more attractive things outside of just that one very narrow sector or part of the overall investment landscape? What would be your thoughts there? Because I think one of the questions clients are asking us as advisors right now is, should we be preparing, right, for a really big correction, a really big downturn? And one of the things that we're all doing as partners on the investment strategy is continually looking for ways to de-risk portfolios, right? And maybe shift to different areas. So maybe just if you could give us a little bit more of your thoughts on looking forward, risk management and maybe the other parts that may not be as dependent on US tech.
Right. So let's take the first part of your question, which I completely agree with. I do think spreading the wealth, so to speak, spreading that where you're getting returns from is a healthier environment. Now, do I think these large U.S. technology companies can continue to do well? Yes. I just don't want to have all my money in them, right? And I mean, trying to pry it out of U.S. investors' hands sometimes can be difficult because it's been so successful. So having different contributors all around the globe is an easier portfolio to live with. And then when you throw in fixed income, I mean, if you think about the world we live in now, where we're actually back to earning coupon, you can actually get income along the way rather than this very long period around the world where we had nearly zero interest rates. The
Right.
40 of a 60-40 is delivering, and then you add in the other aspect asset class, whether it be infrastructure, whether it be REITs, which is a great diversifier, also winning because of things that are going on in the AI space, but it's also been contributing to portfolios. So yes, I feel it's an easier portfolio to live with than just relying on getting all your returns to from one spot. The second part of your question is always an interesting one, with investors often saying, well, markets are at all-time highs. Should I be investing, or should I just be moving to cash? I've learned three things, I think, in my nearly 40-year career. None of them are really just market related. And these are all things that we all control as individual investors. Number one, you got to have a plan. You have to get good advice. You have to manage your taxes appropriately, and you got to stay in the game. And I think that stay in the game aspect is so important, and is really shown through this year. There's a lot of different anxieties going on. Obviously, we know what's going on politically, not only in the US, but around the globe as well, and tensions between countries and tariffs and all that type of thing. A lot of ways that you could have said, I think I'll just sit this one out and look at this marketplace that you would have missed out on, these
Right.
market returns. So I do think that you have to always keep the longer term in mind. You're planning for retirement. Politics tends to be a little bit shorter term, goes back and forth, and who's in charge and who's in power, but markets go up more often than they go down. So you have to stay in the game. It's easier to stay in the game if you can spread your bets and own a lot of things around the world. And that's the environment that we're in right now. And investors have certainly been rewarded for this in a period where there is heightened anxiety.
Absolutely. Okay, well, that seems like a perfect place to leave things off for any clients who are interested in seeing more of Mark's work and a more in-depth analysis. We do have it available for those of you who may have an interest, but I think we've really valued your perspective, Mark. Russell is a valued strategic investment partner in our client portfolios, and we're really grateful, right, for the work that your team is doing to help investors remain in the best possible position over both the short and the long term. Thank you.
Thank you very much. Have a good day.
All right, we stopped